Imagine the whole crypto universe getting shaken by a single headline. And in the background, quantum computers quietly loading the next level. That's the year 2025, where volatility is up, nerves are high, and everyone asking the same question. Is crypto ready for the quantum age? Yes. In this video, we are going to answer the same, so let's dive in. As 2025 wraps up, the latest research points to four big forces driving the crypto space. Markets are super volatile and pretty risk-off. On the other hand, quantum computing is catching up fast and putting pressure on today's crypto security. Importantly, interest in stablecoin and tokenized money is exploding. While now, even traditional banks are using Bitcoin and Ether as collateral, dragging crypto deeper into the core of global finance. Interestingly, on 10th October 2025, Trump threatened a 100% tariff on Chinese imports. As a result, markets panicked. Only in crypto, more than $19 billion of positions were liquidated in a single day, in fact within few hours. Bitcoin longs worth about 4.6 billion, Ethereum longs around 3.8 billion, plus big hits to Solana and other altcoins created panic. Liquidity just vanished and a lot of margin account wiped out. Right after the flush, Bitcoin dropped about 35% from its peak, from above $125,000 to the lows below 81,000. And Ether around more than 45% from its peak value that was close to $5,000. Altcoin fell even harder. But by the end of that weekend, Bitcoin and Ether had largely closed the gap with S&P 500 futures, showing deeper liquidity and stronger institutional support than most people expected. On that day, Bitcoin traded about $56 billion, Ether $38 billion, with big volumes in Sol and XRP too. Zoom out and the downtrend is clear. Bitcoin hit an all-time high of around $126,000 on 6th October. By late October, it was near 114,000, and by late November, it had slid below 81,000, officially in bear market territory. Ether fell from roughly $4,900 to $3,800, then further to under $2,700, a more than 45% correction from its peak. Over the same period, the Nasdaq only dropped about 5 to 7%, but Bitcoin and Ether fell roughly 20 to 25%, showing just how leveraged crypto risk is to tech sentiment. Another drag comes from digital asset treasury companies or DATCOs. MSCI is consulting on whether some of these firms, which hold large crypto stacks on their balance sheet, should be treated more like investment funds and excluded from major equity indices. In fact, the review covers 39 listed companies, 20 already in MSCI indices with a combined market cap of around $115 billion. However, that number is tiny compared to the roughly $700 billion in market cap loss in Bitcoin and Ether since September this year. But sentiment damage is real. One big Bitcoin treasury company watched its valuation multiple drop from around twice its BTC net asset value in June to just a bit over 1.1 by late November. Now, the quantum twist. Classical computers use bits, zeros or ones, while on the other hand, quantum computers use qubits, which can be in superposition, both 0 and 1 at the same time. With interference and entanglement, quantum algorithms like Shor's algorithm can, in theory, crack the elliptic curve cryptography that secures Bitcoin and Ethereum much faster than any classical machine. Today's hardware is not yet powerful enough to break real-world crypto keys in time, but the risk window is shrinking. Top researchers are sounding cautious. A leading quantum scientist suggests we shouldn't be too confident that today's crypto will stay safe for even the next 5 years. Ethereum's co-founder has warned about a non-trivial quantum attack risk by 2030. At the same time, governments are pushing hard. The US Genesis mission puts quantum information science on its priority list, and the NIST process is standardizing post-quantum cryptography. The good news? Bitcoin and Ethereum communities have a track record of major upgrades through BIPs and protocol changes. So these latest research highlights, you should expect mitigation to really accelerate as much as quantum hardware advances. Meanwhile, TradFi is not sitting out. The latest research highlights that a major US bank is preparing to accept Bitcoin and Ethereum directly as collateral. Importantly, beside Bitcoin and Ether, they already take ETFs, yes, exchange traded funds. But why? Because there's real money behind it. One study estimates high net worth investors put about 3% of their portfolios into crypto, around 15% for people aged 21 to 42, and 5% for older investors. With North American high net worth wealth at about $30 trillion, that's potentially $900 billion of crypto. On the other hand, public companies together hold roughly 1 million BTC and about 4.7 million Ethereum, that worth over $100 billion. Crypto-backed lenders often offer 50 to 70% loan-to-value ratios. If we take a conservative 50% LTV and a 10% margin spread, with the expectations that the crypto lending opportunity could reach about $50 billion in net interest income every year. Early crypto banks in Switzerland are already nearing break-even. One already showed positive EBITDA in 2024 and targets full-year break-even in 2025, while another guides for 2026. So what is the catch? Reusing collateral can boost leverage and increase volatility, so regulators will need to cap LTVs sensibly. Let's turn to stablecoins, a central area of focus and among the most rapidly expanding segments of the market. By November 2025, the average stablecoin supply was about $268.7 billion, with total market cap above $300 billion, up more than 400% since around 2020. According to the IMF and BIS, this could jump roughly tenfold to $2 trillion by 2028. Annual stablecoin transaction volume reached about $51.5 trillion, though real adjusted volume was $10.4 trillion. In just the last 30 days, adjusted stablecoin volume of around $1.4 trillion actually beat combined Visa and MasterCard volumes. Around 80% of stablecoin use still comes from crypto trading, and more than 90% of fiat-backed stablecoins are pegged to the US dollar, dominated by USDT and USDC. On the regulatory side, the Basel rules coming in require banks to apply a 1250% risk weight to volatile crypto assets and even extend tough capital treatment to most assets that use blockchains. Banks argue that such rules would kill their incentive to enter the market. The US Federal Reserve and the Bank of England have already signaled they don't plan to fully implement these strict Basel crypto standards, opening space for more stablecoin and tokenization experiments. Asia is already running live experiments, highlighted in these latest research highlights. Hong Kong requires fiat-referenced stablecoins to be fully backed by high-quality liquid reserves, licenses all issuers, and effectively bans algorithmic stablecoins. It's also piloting 𝗪𝗏𝗡 for tokenized deposits across 7 banks. Singapore is building a strict framework for single currency stablecoins pegged to the Singapore dollar or G10 currencies, with focus on sound reserves and redemption, and sees tokenized bank liabilities and CBDCs as the core of its digital money stack. While Japan launched yen-pegged stablecoins backed by deposits and JGBs, with big banks testing coins for corporate settlements. On the other hand, India is preparing an asset reserve certificate, a state-backed stablecoin one-to-one with government debt or T-bills, possibly from early 2026, alongside its e-rupee. China is going slower on private stablecoins, but pushing its eCNY and watching how USD-pegged coins reshape global money. Central banks are also building their own rails. The latest research highlights show that Europe plans to move the digital euro into a pilot phase in 2027, with a full launch targeted for 2029, positioning it as an alternative to USD-dominated private stablecoins. But lawmakers and banks worry about undermining private payment systems and the cost of the switch, so expect intense debate during the pilot. Overall, the latest research suggests CBDCs will grow but still lag the explosive momentum of stablecoins for now. So, what's the big takeaway? First, crypto is still tightly linked to global risk sentiment and tech valuations. A tariff tweet can erase tens of billions in a day. Really, a hypersensitive to macro shocks. The second takeaway is that the doll, quantum computing, is turning from sci-fi into a genuine timed risk, forcing the industry to think seriously about post-quantum upgrades long before the first real attack. Third, Bitcoin and Ether are becoming more like core financial collateral, with big banks, wealthy investors, corporates, and even Swiss crypto banks building business models around them. And lastly, yes, stablecoin. Stablecoins are quietly becoming the high-volume plumbing of digital finance, potentially reaching $2 trillion in market cap and already moving volumes that rival or beat card networks even as regulators race to catch up. We have already covered stablecoin in our previous video. I'll share link in the description to gain more insights on stablecoin. In short, as we step into a world of quantum shockwaves, the battle isn't just crypto versus fiat. It's about which digital money designs can stay secure, scalable, and trusted when computing itself levels up. If you find this video informative, do like and subscribe to our channel. I'll see you in the next video. Until take care and bye-bye.